Howdy everyone, this episode is brought to you by Fireblocks. Love this company. You'll be hearing all about them later from me later in the episode, but now on with the show. What's up, guys? Before we get into today's episode, which I'm very excited about, I just got to do a quick plug for our event down in Palm Beach, Permissionless. It's happening May 17th through the 19th. Super excited about this. We've got a great lineup. Chris Dixon, Do Kwon, Kevin Owocki, the founder of Gitcoin, whole bunch of really interesting folks that I'm excited to have you hear from. Also, we just launched the inaugural Blockworks NFTs. Permies. These things are sick. They were designed by 3D print guy who used to work at Pixar. Really cute. I already feel very attached to mine. Head over to our website. You can get more information and mint your own. If you get a Permie, you get all these very cool, you're like a VIP at the event. It's a lifetime ticket for permissionless going forward and a whole bunch of other really cool stuff. So check it out. Head to our website. See y'all down there. All right, everyone, welcome back to another weekly Roundup edition of On the Margin. Today, I am joined, as always, by my indubitable co-host, Mr. Mark Yusko. What's going on, Mark?
I'm doing great, except I'm a little tired. I'm still on mountain time. I was out skiing with Will for spring break, and so you got to deal with the ski stubble today. And I'm going to do the reveal, and it's a crazy one. So I'm wearing the Carolina, North Carolina socks today because it's a big weekend. First time Duke and UNC meeting in the NCAA Final Four. You obviously know who I root for. But the real thing is, Michael, I just couldn't put on Bitcoin socks today since I sold all my Bitcoin. I just had a change of heart. I just couldn't do it. April Fools, baby!
I forgot. Oh shit, it's my dad's birthday today. This is a good reminder. I got to give him a call. All right.
April Fools. I almost got you.
You did. Did you see the fear in my eyes? I was like, Mark, no, man, please say it ain't so. All right. Happy April Fools, everyone. Happy birthday, Dad. I'll give you a call later. All right. That was good, though. That was very good. You had me there for a second. Maybe the market is giving us a little April Fools as well because we've got a yield curve inversion, but perhaps it is just psyching us out. That is my absolutely horrendous non sequitur into our first topic.
That was a good non sequitur.
Hey, that wasn't horrendous. Okay, I'll give myself some credit there. All right, here, let's see if I can share my screen. So we're looking here at the spread between the 10-year and the 2-year. It briefly dipped into negative territory, which means we have officially got an inverted yield curve. Before we get into that, Mark, can you just describe, for those who might not be familiar, right? Folks have probably heard a lot about this, like, the kind of the boogeyman, when the yield curve inverts, that means we've got a recession coming up. Why do people focus on this, right? Why do people pay attention to the yield curve inverting, and what has that kind of historically meant?
Yeah. So if you think about a yield curve, so on the left-hand side, it's the short end, and on the right-hand side, it's the long end. So shortest duration treasuries, longest duration treasuries. And in a normal functioning world, the curve is upward sloping, like a security market line, right? You're going longer out in duration. You have to get compensated for that risk, so you have higher rates. Well, what happens when the economy gets super hot, the Fed historically has raised rates on the short end and pushed the short end up. So think about, an upward sloping line. Think about the left-hand side getting pushed up, and you get to flat. And because the long end starts to actually not rise or even fall if it believes that the economy is going to slow down in response to the higher rates. So what happens with a yield curve inversion is that short end pushes up, it gets flat with the long end, and eventually, tilts the other way, inverts. And, like the guys I saw out in Colorado doing the inversions off the ski jumps, I did not do that. But the thing that I think is different this time, I hate that phrase, right? It's never different this time, but what is different is normally the reason a yield curve inverts is because that long end of the curve is signaling economic slowdown in response to the higher rates. This time, that ain't it at all, right? The long end has been pinned right around 2% for a long time. Think about 2% interest rates are not a sign of economic strength. They're a sign of economic weakness. And other than the little blip in growth, quote unquote, post-COVID lockdown, which was just illusion, right? If you lay everybody off, you put them in their house, and then they go back to work, you didn't create a new job. You didn't create economic growth. That's the broken window fallacy. I break the window. I don't count that. And then I count the rebuilding. Or hurricanes, right? Hurricane wipes out Louisiana, where the Final Four is this weekend, during Katrina. They don't count that against GDP. But then all the rebuilding, that's positive GDP. Yeah. So I think the problem we have now is people believe that the Fed actually is doing anything at the short end of the curve. The short end of the curve has been wrong for 13 years. It was at zero interest rates. It was held down artificially to liquefy the banks. It should have been much higher. Short-term rates should equal nominal GDP growth. That hasn't been the case other than the last 10 years. For the last 100 plus years, that was the case. So that's a long answer to your question, but this is a really important concept in that interest rates, in theory, are the governor on economic activity. I believe sub 2%, it breaks. It just doesn't work. And the whole Fed model, how you justify higher stocks based on low yields, just breaks down. Because just do the math, right? If rates are zero, are stocks worth infinity? The value divided by zero is infinity. So, of course, if you looked at the valuations of some of the companies out there, you would say, "Oh yeah, that's how it works."
It's interesting. I mean, we've seen that idea of that kind of phony growth that you alluded to during COVID, right? Which was kind of fueled by monetary accommodation, fiscal accommodation. You can look at a whole bunch of different charts, and there's this extreme reversion going on right now, right? Like the most obvious is when you look at kind of those pandemic darlings, like the Zooms and the Pelotons and whatever's of the world. I mean, they've done a complete retracement, right, of basically all their gains. I wanted to, speaking about bonds specifically here, Joseph Wang, who hosts a show with my colleague Jack Farley, Forward Guidance, has this kind of theory. So he was a trader at the Fed. He's kind of got this theory about a pre and post great financial crisis world and how things have changed post great GFC. Where, due to like a bunch of banking regulation, right? So Basel II and III, and I can't really remember what they're called, but basically the financial system said, hey, banks, you were taking on way too much risk before, so we want you to buy safer assets, AKA treasuries, right? Yeah. And those treasuries tend to be longer dated, right? So that just means basically there's this structural bid at the longer end of the curve. And that also kind of keeps...
I wish that is such an elegant analysis and perfect, and I just wish it were true. The part about the reason for why the banks are buying the treasuries. The banks have this relentless bid on treasuries because it's free money. They borrow from the Fed at zero. Right? This is all part of the Ponzi. They borrow from the Fed at zero. They buy the treasuries because no one else will buy them. The Chinese won't buy them. The Russians won't buy them. And we have to issue so many treasuries because the government is out of control with their spending, running a $3 trillion deficit. And it's just a Ponzi scheme. And we've talked about this, right? When you have too much debt, you got four options. You pay it back, you restructure it, you default on it, or you devalue it by debauching the currency. You can't pay it back, right? Even if you taxed 100% of the wealth, forget the income, all the wealth of all the billionaires in the United States, all of it wouldn't pay back 1 year of debt. Okay, so you can't pay it back. You can restructure it, but then someone's got to buy the restructured bonds. Nobody to buy. Chinese won't buy. Russians won't buy. Nobody will buy. Can't default on it because then you get kicked out of office. So you debauch it. And that's all that's happening. We are debauching the currency. We've talked about this in the past. We're not seeing inflation. We're not seeing demand pull inflation. We're not seeing normal supply demand. We're seeing massive currency debasement. Massive. And that's why assets like the one I didn't sell, Bitcoin, are going to continue to rise as a perfect store of value.
Let's talk about what's the relationship between the yield curve and stocks, right? This graph's a little blurry, right? So bear with us here. But basically what we're looking at here is in previous periods where the yield curve has inverted, how stocks have behaved. So we're looking at August of 1978, December of 1988, May of 1998. Geez, the years that ended in eights, not great. February of 2000 and December 2005. These are all yield curve inversions. And what it looks like is, actually, it seems like there's a period of time, 350, 400 trading days after where stocks don't react. But then there's a pretty consistent plunge, right, of anywhere from, to 10% to all the way down to 30 or 40%. So, what's this just almost from a first principles, why do stocks react, right, when the yield curve inverts?
Well, because stocks are a leading indicator of economic activity. So the inversion is a leading indicator. So it's not like when the yield curve inverts, immediately you're in recession and immediately stocks crash. So what happens is the yield curve is basically the bond market participants telling you that something's amiss, that they don't believe that, or that they actually do believe that the Fed tightening liquidity is going to cause stress in the markets, and they start selling or so they start moving into longer duration assets, which pushes the yield down. So they're afraid. Then the stock market doesn't really buy it because it doesn't see any slowing economic activity, it doesn't see any GDP numbers. And so, but eventually, like you say, at some period of time, it's usually around 9-ish months later, it says, yep, that was right. The Fed did succeed in slowing down the economy. The things are getting worse. So the market declines. And the depth of the decline is determined by how high the valuation was. So based on that measure, this decline could be a doozy.
Actually, I'm looking at this, and it looks like the performance, looking at this chart, stocks actually don't do that horrendously after, post yield curve inversions. I mean, just looking at this.
For the first 9 months, for sure. For the first 9 months, it's really not that big a deal. In fact, you could even have some rise as people say, oh, look, the Fed's going to engineer a perfect soft land, which they've never done.
All right, yeah. All right, I've got another question for you here. So, when you talk about almost this idea of flight to safety and investors, de-risking, taking risk off the table, one thing that's occurred to me is even though we've seen this huge reversion in some of these, let's call it, some of them are meme stocks, right? But some of them are just kind of more high flying tech. Yeah. The indices have not sustained quite so much damage, right? And I wonder if that's because people see big tech, right? So like the Apples and Googles and maybe not Facebook, but Amazons of the world actually as a defensive play, right? So they actually make up
it's such an elegant answer, and I don't mean to interrupt you because you were on a roll, but it's such an elegant answer. But again, I wish it were true. I wish that investors, in air quotes, were actually making that decision, that they were actually actively making a decision. Oh, these are safe. These are good. The growth is good. It's passive. It's just so much money has flowed into passive indices, into index funds, and my computer's trying to take over again. Passive is dumb, and I don't mean unintelligent. I mean rule based. It's not allowed to think. So everybody's got a 401k, a 403b, and every 2 weeks, money gets taken out of your salary and it goes into the stock market. You don't think about it. It just happens. And you don't get to say, I think Apple's really highly overvalued. I don't want to buy it. Nope, you get 5.6% of it, irregardless. And that puts relentless pressure on those FANG man stocks, Facebook, Amazon, Netflix, Google, Microsoft, Apple, and NVIDIA. And they are more than 100% of the gains of the market over the last couple of years. And it's kind of sad because when it eventually does end, and it will end, as it always has, people talk about the central bank put, right? They talked about the Greenspan put, and the Greenspan would never allow the market to go down. And in 1999, when it started to go down because people were about Y2K, he pumped $500 billion back when $500 billion was a lot of money. Now you got multiple trillions. And everyone thought the market could never go down. And then from 2001 to 2002, it went down a lot, 58% peak to trough. And then we had the Bernanke put, because, Ben, he was the man of the year and Time Man of the Year, and he wrote this book, and he was the savior, and he saved us. from the crash? And yeah, not so much. China saved us. They printed $4 trillion and bailed the world out. But Bernanke put was supposed to never allow the market to go down, and the market went down 54% peak to trough. And then now it was the Yellen put. Now Yellen did get out of Dodge before her put expired. Because remember, 85% of options expire worthless. If you ever have the urge to buy an option, just stop and do the opposite. Yeah. Like if you want to buy a call, just buy a put. If you want to buy a put, just buy a call. Because you'll be more often, 50-50 chance of being right. But if you actually do what you think you want to do, you'll have an 85% chance of being wrong. But which is crazy, right? But the problem is now we got the Powell put. And everybody says, Powell can never allow the market. The Fed does not control it. When market participants finally wake up out of their stupor, and right now they're in a stupor, and it's because of stupid ideas like indexing as a fad. I mean, the core of your portfolio should never be in an index fund. Think about it. An index fund is a momentum strategy.
Right.
It works great in monetary accommodation, but as soon as monetary accommodation slows, you have the absolute maximum exposure to exactly the wrong asset. 2000, maximum exposure to tech. 2008, maximum exposure to financials. Today, maximum exposure to tech. It doesn't end well for you, but people are going to do it.
Well, I just have like a question about, because right now, when you look at a lot of these defensives and industrials or whatever, I mean, at one point those would have kind of been considered tech stocks, right? I mean, most companies that become successful and ascend to the top of the market leverage technology in some way, shape, or form, right? You don't think about Exxon as a technology company, but I mean, they were kind of at one point, right? I mean, figuring out how to do E&P is that's technology heavy. Isn't that the natural evolution though of these big tech companies? Like they become at the beginning, they're these high flyers, they get valued on growth, et cetera. But then they transition to like the multiples on, okay, maybe not Amazon, but Google. It's pretty fair, honestly. It's not a crazily valued stock.
Yeah, it is. Yeah, it is. I mean, it's not as crazy, right? But that's like, that's like getting, you're swerving late at night, you're driving and a cop pulls you over and he says, what's going on? You shouldn't be driving, right? You're drunk. He says, well, yeah, but I'm not as drunk as my friend passed out in the back. Someone had to drive, right? I mean, not as drunk as the guy passed out is not a good reason to take the wheel. You can call an Uber. So, being only a little crazy, I'm just going to pull it up here real fast. So, I use Apple all the time. Everybody says, well, Apple, it's such a bargain. It's only 35 times. I'm like, well, okay, but here's the problem. It's 35 times, but its growth rate is low single digits. You don't pay 35 times for low single digits. But no, it's 20%. I'm like, no, that's earnings per share growth because you're issuing debt to buy back stock to financially engineer. But the actual net income growth year over year is very small. Google, 25 times. Google's growth is not worthy of 25 times multiple. It's because, like this morning, the reason I was late is, made me update freaking Chrome, which was a pain in the ass. And have I changed? Have I gone to DuckDuckGo or something else? No. But eventually I will find something that, I do work on. Now, the one thing I will grant you, and it is a really good point, Michael, that you make, is the world did change in that these are not normal companies. They're networks. And networks are different. Networks are very different. It's why digital assets are so valuable. Networks are very, very different. They grow exponentially, not linearly. And, Netflix or Amazon or Apple or Google, these things are networks, and they have a different valuation because their profit margins are much higher. Their costs grow linearly, but their revenues grow exponentially. And that point I will grant you that there is some belief that will go on to infinity. I actually believe in gravity. I wrote a long letter about this. Newton was right that gravity does actually still function, and that valuation does matter, and you can't suspend all disbelief like going to the movies on these big cap tech stocks. But you're right. There is a narrative. There is some. These are like bonds. And you've heard it. Buy stocks for income, right? Buy the safe dividends, like ExxonMobil. Problem with ExxonMobil, it's an industrial conglomerate. Half the time it makes money when prices of oil go up, right? The other half of its company loses money. The refining loses money when oil prices go up. Flip-flop, oil prices go down. The refining part makes a lot of money. Distribution makes a lot of money, but their E&P loses money. So it's just an industrial conglomerate. It's been a great short for a long time, but now people think it's an oil stock again, which it's not. And it rallies because commodity prices are going up, which is the great segue to your next point.
Yeah. Well, what I was going to ask you is, okay, so if gravity applies to equity valuations, do you think it also applies to commodity prices? And looking at this chart, I would say it looks like it does, right? So I'd be curious to get, this is a now historical spike. So we're looking at the CRB commodity index. This is a total return year-over-year percentage. And I think this is all-time high. All-time high. And for those of you who are listening along, I'm talking about, we've got World War II on here, the New Deal, the Korean War, the Yom Kippur oil shock, the oil embargo back in the 70s, 9/11. There were some historic spikes here, but this is the biggest of them all.
And the charts, it's a total chart crime too, because it's so off the charts in terms of literally that they had to do that little, red line where the bar isn't actually as high as it should be relative to all these other spikes. Now, there's two things that are happening here. So, one, commodity prices were at historic lows relative to paper asset prices. So, that's part of it, right? It's the law of small numbers, right? When you fall 95%, you got to be up 20-fold just to get even. So that's part of it. But the real answer here, and this is, I got in a little, I wouldn't call it an argument, but Greg Foss and I, he commented on something I said about, there's no inflation, which seeing is currency devaluation. So it's the same thing. I'm like, And look, I love Greg, and he's way smarter than me, but it's just not right. That part is not right. Demand pull inflation is very different than currency debauchement. This big movement we're seeing in commodity prices is currency debasement. And we've talked about this, right? The craziness. My parents were moving my parents up from south here near Wilmington up to Durham, right next door. That town, where the University of New Jersey at Durham is. I can't say the D word. And we put their house on the market. And they live in this community down. It's like one of these golf course communities down on the coast of North Carolina. And it's a nice house. Don't get me wrong. It's a perfectly nice house. Bidding war, sold for way above asking price. Just
what's up with that?
Dumb.
What is up with that? This is happening in New York too. It's unbelievable.
Everywhere.
It's not even like 20% higher. It's like 70% higher for dumpy apartments, and it's like they just don't even exist. You can't even get them. I don't understand.
So what? No, what it is it's people migration because of work from anywhere, right? You and I are doing this in real time instead of having to be together in a studio like the old days. Yeah. So now you got people say, well, I'm gonna work where I want to live, and so places where people want to live, there's a lot of demand for housing. There's just not enough supply. But the real reason is funny money.
Yeah.
Right. Houses don't grow. They don't appreciate. They don't get better. They actually wear out. Like if you did nothing to your house over a 30, 40-year period, it would fall down, right? It would just, not literally fall down, but it would break. Things break. And so what's happening here is the currency, they printed 50%, half of all the dollars in the history of the Republic, 256 years, in the last 2 years.
Yeah.
That is currency devaluation. And that is why commodity prices are spiking. It's why housing prices are spiking. It's why food prices are spiking. Now, there's other things too, like supply disruptions in oil and gas, because not enough people spent enough money to fix their wells, because there was all the ESG nonsense of, we got to have immediate, like this nonsense with the president saying, the average family could save $80 a month in gasoline if they just buy a electric car. Yeah. And the extra $30,000 or $40,000 that they have to spend to get that electric car, to go to your cronies that are paying you huge amounts of money to make that comment, more than offsets the savings of gas. And you end up net negative, because remember, cars don't appreciate, Elon. They actually depreciate. They go to zero. Even Teslas, used Teslas, don't sell for more than new Teslas. I got news for you. They are cars. They wear out. They break. And God forbid, the first time people have to change those batteries, watch what happens to the value of freaking Tesla cars.
You reminded me of something. I have a theory that I don't want to go on too long of a tangent here, but I've got a theory for you here. You know how... So over periods of time, people prefer to live in either rural or urban settings. So like in the 1940s and 50s, right, there was like the white picket fence house in the US, and everyone wanted to live in the suburbs, and it was much more expensive and popular to live in the suburbs than the cities. And it's been reversing for the last however many years, and now it's much more expensive and popular to live in urban settings. I think what you were just alluding to with us being in different locations, it's easier to work more remotely, et cetera, is going to push people out in general. And I think one of the things that's going to usher people out is actually the decisions that employers need to make over wages. Because you as an employer, right, you've always had this kind of option where do you pay people more who live in New York versus Wisconsin? And people have generally done that, the COLA, right, cost of living adjustment. It's more expensive to live in New York, so people who live in New York get higher salaries. But now there's this weird thing where everyone's been kind of working remotely, and wages are kind of going up across the board, and workers are basically like, I should just get paid depending on the merit of my work. It shouldn't really matter where I live, right? And employers can say, but that's unfair, but you live in New York, blah, blah, blah. It just isn't going to matter. So I think what's eventually going to win is that idea that people get paid depending on the quality of their work. And you can see it in crypto. Imagine trying to pay people differently in crypto based on where they live. I mean, that's just a joke. So I think eventually what that means is the value proposition of living in a rural setting is just going to be so much better because your dollars go further. It's actually going to push people out of cities. That's my theory over the next however many years. Maybe that's not that novel.
It's definitely true. It's definitely true for family people who have families. For singles, I'm not 100% sure. I think the idea is alluring, but our experience with young people in our firm, right? We're here in Chapel Hill, North Carolina, and we recruit people to come back right out of school, and they come back and like, oh, this is great. Oh my God, this sucks. It's so boring. There's nothing to do. And so then they go down to Charlotte for the weekend, or they fly up to New York, and they're like, hell, I want to live here. And so then they get a job there, and we lose them. Yeah. And that's happened for years. And so I do think you're 100% right that anyone with the flexibility to do what you described, right? I mean, I sat next to people on the chairlift who had moved to Colorado. Right? We like to ski, so we just moved here. And I see it all the time here in North Carolina. We said, we picked a map, and we said, it's the halfback state, right? It's not too far south like Florida or Georgia. It's not not north in the cold, and so we're moving to North Carolina. Next door neighbors, right? Came down from Jersey, moved here sight unseen, right? So picked a house, and got in the bidding war and bought it. So, but I think your premise is right that there is social momentum around this idea of pay me for my merit, as opposed to me being a static in a matrix. And because we have it, right? We have people in New York, and we paid them more for the same job as people in North Carolina. Now it's interesting. It was always again, that was demand pull. It was the people in New York demanding higher wages. to get their labor.
Sure.
It was never, to your point, the people in Chapel Hill saying, well, wait a minute, I'm doing the same work, so I should get more. That's an interesting phenomenon that I think could put upward pressure on wages, which will put downward pressure on prices, which would mean that chart that we saw in the stock market could start to be worse.
This episode is brought to you by Fireblocks. I talked to a lot of fast-growing crypto-native funds, crypto banks, exchanges, and the like, and they all tell me they have the same two problems. One, their treasury management setup sucks. They've got analysts wasting time and money on manual transactions. Two, they are not happy with their current security setup. They're sharing passwords, they're sending test transactions, and they're worried that their funds might be at risk. Fireblocks is a platform that solves all of that for you. They're a one-stop shop portal which automatically plugs into exchanges, trading venues, etc. They source deep liquidity and solve everything from day-to-day crypto transactions all the way down to complex DeFi strategy. And the best thing about Fireblocks is that they offer scalable solutions with industry-leading technology. Doesn't matter if you're a 2-person crypto fund or a 2,000-person crypto exchange, these guys have you covered. And the last thing that I'll say about this company is that I have known them for years. They are a high-integrity team. They ship product like no other. I would trust them with my own funds. So, click the link at the bottom of this page and tell them that I sent you. Very, very important that you click the link at the bottom here. Otherwise, they're not going to know that I sent you. And then how am I going to get credit? So help a brother out. Click the link at the bottom of this episode. Tell them I sent you. I think you're right. And obviously, it's too simple to just say this is what's going to happen. As a relative young, I will say, I understand that because it is nice to be in the city. I do have a bunch of friends, though, who are my age. And I guess these are the people who are kind of in relationships. But a lot of them moved out west. They were like, look, I don't want to be in the city anymore. A lot of them moved to Utah. My family, I guess they're relative olds. Sorry, mom and dad. Happy birthday, dad. They moved out to Montana. So I think you're right. It depends.
It depends what you value too, right? People who are outdoorsy, who love to bike and ski and hike. I mean, how nirvana. I mean, think about it. Living in the, near the Utah national parks, being able to go biking and hiking and still log on. And it was one of my favorite commercials. It was the guy that was he had the pickup truck and he had a screen that popped up and it was an office backdrop, like before virtual backdrops, and it was a picture of his office and he was doing a zoom, from the middle of nowhere. I can see it. I mean, I loved, right, being out in Colorado, going out skiing with the little guy, get up a couple hours early and you can do a little work. It's good quality of life.
So Yano and I were out in Sedona for the last month.
Yes. We had the crappy background for a couple of weeks.
Exactly. It was the Chugi background, which is, for those of you who aren't familiar with it, that's like live, laugh, love. I'm just going to say public service announcement. If you ever feel the need to decorate your home like that, please, for the love of God, do not.
Watch the commercial and throw it out.
We met this couple out there who's doing van life, and they had they bought this van, outfitted it, and they'd been driving around in it for a year. And actually, this guy hadn't even told his employer that he was doing this. Yeah. He was just he had like one of those work backgrounds or whatever, and it just never even came up. I want to get your opinion on
my 11-year-old is on me to do that. He's like, Dad, we should just get an RV and we should just drive. I'm like, yeah, you would learn more from that year than going to school. In the current state of schools. And that's not criticism of schools. It's criticism of the dumb policies that were created around the nonsense. But I mean, I feel badly for the teachers and the kids, but I actually believe my 11-year-old would do better in an RV traveling around the country than what's going on in the current system. But we'll figure that out.
I want to get your thoughts on the ruble. So the ruble has largely recovered, actually, since that kind of precipitous drop right at the beginning of the war. I'm also reading this headline here from Bloomberg. So we talked about how Russia is going to be demanding its oil exports to be settled in rubles as opposed to dollars or like small amount that's settled in euros or whatever it is.
King dollar dethroned.
King dollar, baby. And here's the headline I'm reading, which is Putin says gas exports will be halted if ruble payments are not made. Russia to demand rubles for gas sales from April 1st, which is, we are recording this on April 1st. So today.
April 1st. Today.
Yeah. So basically foreign buyers are going to need to, and I mean, it makes a lot of sense. I mean, he does kind of, I mean, again, not a geopolitical strategist. It looks a little bungled, right? I don't think Russia's coming out of this big winner, but he does kind of have the world by the short hairs when it comes to his natural gas, his gas exports.
Playing chess while we argue about how to set up the checkerboard, right? Look, we're run by octogenarians. The octogenarians are like Notre Dame football fans or Notre Dame basketball fans, right? They remember a past that never was. And that's what's going on, is they live in this petrodollar system, which has been going on since the 70s, and it's over. I mean, we are transitioning away. It's not like a light switch. It doesn't go off like a light switch, but it is over. And the dominance of the dollar is going to fade. And it's China and Russia secondarily, but it's really China. This is China's plan. China wants to be the world reserve currency, not a. Today they are a world reserve currency.
So I'm going to voice the devil's advocate opinion here, and we actually got to get him on the show next week. Jason Buck, host of the Pirates of Finance show. I know you know Jason too. But he kind of voiced this devil's advocate opinion where actually, there's a lot of folks, you and I also, who's saying this is kind of this is the beginning of the end for the dollar, and to advocate for Jason's perspective in maybe a less elegant way than he would do himself, which is why we got to get him on the show. He'd say
he's awesome.
He's the best. He'd say, well, actually, what these sanctions have shown is how much the world depends on the dollar, right? And actually how crippling these sanctions have been for Russia is it's actually kind of a show of force, and certainly the Western world is rallying behind.
Define crippling, right? Has it really been crippling? Now, if you're an oligarch and you illegally had your assets seized, it's crippling for those individuals. Bullshit, total bullshit, no due process. Because of your citizenship, your assets are seized by foreign governments. That is a horrifying world to live in. Horrifying. And so, but Russia, right, every single day, the gas goes out the pipelines to Europe, and they send money to Russia. And now they have to send not dollars, but rubles. This is big. I mean, this is big, big, big. Today is a really big day. And I don't think people really comprehend that we believe our sanctions did so great. I say this all the time. If we called sanctions what they are, starving women and children, right? That's what economic sanctions that the U.S. has done for years, whether it's Iran, whether it's Venezuela, what was it? If you actually look at the impact that it has, it hurts the people not the people you think it hurts, right? The oligarchs are fine, right? You seize their yacht, they still have money, right? Putin, he's the richest guy in the world still. Think about that. He is the richest man in the world, richer than Elon, richer than all of them. And in theory, some of his assets went down, but his other assets are now, to your point on the ruble, they're rebounding. And the ruble is going to continue to get stronger because there's going to be increasing demand, because every single day people get up in Western Europe. They have no choice. They have zero choices but to buy gas from Russia.
Well, the other thing too that Jason mentioned is that it's very difficult to predict, to call timelines on this sort of thing. Right. And that 100% agree. That's a completely valid point. So just folks, when you're listening to this, I don't think, at least I'll speak for myself, and Mark, you can chime in. I don't think we're calling for the end of this system tomorrow. But what I would say is a general high level principle is that whenever you do have a monopoly that tends to get abused, that is the beginning of the end for that monopoly, because there's a reason why monopolies are very sticky. People don't have alternative choices. An enormous amount of power gets amassed. look at Google or some of these social media websites as a most recent example. But once you do start abusing it, it's eventually people say, okay, this is no longer working for me, and another option is found. And what I would say too is you hear a lot of people say, oh, it's not going to be sudden, yada, yada. I think it's very difficult to predict timing, but actually these changes do tend to happen very quickly. It's like, right, all of a sudden and then all at once. That's not the right phrase, but you know what I'm talking about?
It's the Hemingway quote, right? How'd you go bankrupt? Slowly at first, then all at once. And
right.
100%, that's how this works. And look, the idea that any hegemony is permanent is nonsensical, right? Now, the person who benefits from the hegemony believes that it's permanent, right? The Romans believed that the Roman Empire would persist. They didn't think that overspending and cronyism and becoming lavish and the Nero and the beautiful parties and the palaces, they didn't think that would end. They didn't want that to end. The Ottoman Empire didn't want to end. The colonial British Empire, right? If you were in the 1860s, right, America was an emerging market run by gangs, right? Watch the movie Gangs in New York. That's what it was like. It was a dangerous place to live in the United States. And the center of the universe was London, England. That was the center of the universe. And the sun never set on the British Empire. They did not want the pound sterling to lose world reserve currency status. Mm-hmm. They did not want that. How did it happen? They overspent. They also did something that we now are doing. They invaded Mesopotamia. They incurred a bunch of debt. That debt crippled the economy, and that gave the opportunity for Hitler and others to attack and try to bust up the Western hegemonic rule. And the result was an opening where an upstart young country said, hey, I think we'll be in charge. And
that's us.
That's us. And here we are.
Us.
And we think it'll never end. But what's happening, the old guys at the top, the Neros at the top, are cronyizing the world. All the money's funneling up to the cronies. The average person is getting crushed. I mean, I got a really sad email from my brother that he was like, dude, I went to the store and I just can't make ends meet. And I just like, yeah, I hear that. And, the family will band together and we will help each other. But it's crazy. I mean, I went out to breakfast with Will yesterday. We had one thing of pancakes and one thing of eggs and bacon, and it was like $60.
Yeah.
And it's a ski resort and all that, but still $60 for breakfast.
Yeah. One point about the Roman Empire, just on the point of Jason's, I think, correct observation that calling timing on this is really hard. Roman Empire got founded in 750 BC. There were the civil wars, right, which was the transition from the Republic to the Empire around like 28. That was wrapped up in like 28 BC. And then it was another 150 years before there was the peak, right? So just saying, it's like very difficult to actually call timing on a lot of this stuff.
100%. The only thing that over the last 2,000 years, the one thing that has changed is those epochs have shrunk. They've averaged around 70-ish years in the last 300.
Sure.
And we're kind of up against that from 1944. So again, I'm not calling for it tomorrow. And I would love, just like we did with Brent, right? Brent has this view too. He's like, the dollar is definitely not going to, not going to lose hegemonic strength. And I love these conversations. And I've had this conversation with Jason multiple times, actually in Aspen, where I just was. I was in Snowmass. I don't like Aspen. I like Snowmass. The poor man's Aspen. But because I like it better. It's just better. But the interesting thing is we had this conversation at a Real Vision Blacklist event, and it's a great conversation, and it would be fun to have on the show.
We'll grab them. You know what is my favorite historical fact just about this before we transition to our last topic is us looking back at ancient Rome now at this time period that we're describing, right around the turn of the millennia or whatever, that is actually less time than someone living then looking back at ancient Egypt. Isn't that crazy? Is that
so
nuts?
Great.
Because like you and I probably
so awesome.
don't think about that. It's like, oh yeah, Rome ancient. It's like it's ancient history, right? But you know, for someone literally as far back as we think of ancient history, they're looking at the Egyptian pyramids, and that was the creation of the pyramids was even longer than Cleopatra.
No, look, I think
I just love that fact about history. I think it's so nuts.
It's one of the greatest facts.
Yeah.
And what I also love is, I think I said this the other times, you know, there are 3 sets of pyramids, right? The one that everybody talks about in Egypt. There's another one in Latin America, and there's another one in China. All 3 sets have 3 pyramids that make Orion's belt almost perfectly if you're looking down from satellite image. And when you look at the 3 dots, they make Orion's belt. I mean, literally my mind is blown. But the better fact, let alone that aliens must have created those, the other better fact is 1 ounce of gold over that whole 5,000 year period bought a fine person suit. From Cleopatra's day to the Roman Empire.
Pretty good tech.
To today,
yeah.
1 ounce of gold has bought a fine person suit.
Right.
That is awesome. And that's because gold is money, the only asset that exists in the absence of liability. And it's why I didn't sell my Bitcoin and why you should do that.
Yeah. Another thing that I just want to correct, because we got a lot of comments on this. But I made this comment on silver and I didn't really understand it. Vehicle speculation. You kind of corrected me. I've done some research into it. I didn't understand the industrial use case of silver. I just want to say for all my silver lovers on the show, yeah, I was wrong about that. So, yep, I was wrong. That's what you get for speaking out of turn.
The silver bugs are almost as bad as gold bugs. I mean, good. I don't mean bad. I mean almost as vigilant and
yeah. I was wrong about it. I just didn't understand it, and that's what you get for talking up. All right, now we're talking about big things, turn of century, big changes in systems.
This nonsense of people checking what we actually say. I mean, when did that happen?
It's ridiculous. No. It's ridiculous.
I mean, come on, ridiculous.
Who could be held to those sorts of standards?
Come on.
All right, there was a really interesting note for those of you who are into issues around financial plumbing. You might know a guy named Zoltan Pozsar. So he's at Credit Suisse. He's a great analyst. Came out with this note: Money, Commodities, and Bretton Woods III. So you're going to have to bear with me here. I'm just going to read the opening couple of paragraphs of this note. It is really, really good. I highly recommend that folks find this and read it. Credit Suisse Research has always prided itself on thought leadership. In today's environment, where we have to navigate a global conflict between great powers and an unfolding crisis of commodities, thought leadership is more important than ever. The current environment is perhaps more complex than the crises of 1997, 2008, or 2020, for the problem is not only nominal, parentheses, FX pegs, par, or the great overdraft, respectively, but also real. Commodities are real resources: food, energies, metals. The resource inequality cannot be addressed by QE because you can't print money, or you can print money, but not oil to heat or wheat to eat. Wars also upend the dominance of currencies and serve as a doula, don't know that word, to the birth of new monetary systems. What Deutsche Bank's Bretton Woods II framework was to the first decade of the new century, and what QE and Basel III then were to the second, post-GFC, decade of the new century, we believe that our Bretton Woods III framework will be to the third decade of the new century and potentially beyond. If we're right, our framework will be the right framework to think about how to trade interest rates in coming years. Inflation will be higher. The level of rates will be higher too. Demand for commodity reserves will be higher, which will naturally replace demand for FX reserves, treasuries, and other G7 claims. Demand for dollars will be lower too, as more trade will be done in other currencies. And structurally then, the negative cross-currency basis, aka the dollar premium, will naturally fade away and potentially become a positive cross-currency basis. Lot of words there, but I mean, it's fascinating to hear some of this come out of Zoltan's mouth. And for those of you who know Zoltan, this is a guy who deeply understands financial plumbing. He's very smart. He does not speak off the cuff.
No, it's awesome. And by the way, doula is a person trained to provide advice, information, emotional support, and physical comfort to a mother before, during, and just after childbirth.
No kidding.
So basically, as things change. And look, he's so right. And he's great. I mean, as an analyst and as a writer. And so I loved hearing you read. It's like Shakespeare. It's like prose. But the issue here is exactly what he said. You can't print commodities. And that's why the commodity prices appear to be spiking. It's not that they are spiking. It's that the currency we price them in is just plummeting. I mean, it's plummeting. And this is this whole idea about the strong dollar. The dollar's strong. No, it's not. If it costs you twice as much to buy a barrel of oil or to buy a bushel of wheat, it doesn't, the wheat didn't get better, right? The wheat is not more enriched. The oil burns the same amount of BTUs. It ain't better. It's that the currency is getting destroyed. And that inequality goes to the average person so much more than the rich. And again, I will argue that this is the dictator playbook 101. This is what dictators do. They impoverish the masses to make them dependent, and then they give them handouts to buy their votes to stay in power. And that is what's happening in the United States, and it's frightening. It is absolutely horrifying to think of people calling for UBI and calling for handouts. I know you have a different view on UBI, which I respect, but this nonsense of give me free money to make up for, like Gavin Newsom, here's $400 for increased gas prices. Now he does it exactly the wrong way. He does it based not on income, but based on car registration. So the dude who has multiple cars gets more money, although they did cap it at two. So
that's why it's all. So I'm not a believer in UBI in any sense whatsoever. I don't think. Okay. I don't think you can give someone something for free and have them value it. I think that actually weirdly goes with even though if I was a single issue voter, it'd be on education. I still don't actually believe in free education. That's tough. It's hard. I think it's a hard balance. Just if you've ever had experience trying to give someone something for free and then have them value that thing, it's more difficult than you think.
Well, it's crazy.
Yeah.
Think about it. You get what you pay for.
Yeah, you get what you pay for.
People don't value. Okay, just look at a rental car. Get in a rental car that's been rented a bunch of times.
Yeah.
And then get in somebody's new car and see the difference. When you own something, you take care of it.
Yeah.
Right? The whole VRBO thing.
Yeah.
People don't respect what's not theirs.
Yeah. And we've talked about this too. I think it's criminal how expensive college is in the US, but I actually used to work for this firm that was headquartered out of Sweden, and they have some kind of like semi-free education system. They were like, look, there are actually drawbacks to that too. Like nobody takes college as seriously as you guys do. That's funny because like a lot of people party a lot in college, but that was their perspective. It was just interesting to hear. But I do want to get your perspective. Like a couple of things stick out to me here, right? So we're talking about demand for commodity reserves, persistently higher inflation, persistently higher rates as well, which is actually pretty interesting, and lower demand for dollars in general. And this is kind of fitting into this narrative that I've been hearing a lot of like a multipolar world, right? So, it's been a unipolar world all based around the United States as the sole superpower in the world. And now maybe it's China, maybe it's some sort of coalition of China, Russia, other powerful Eastern countries, whatever it is. But, we're starting to see kind of a reorganization geopolitically, based on supply chain, based on ideology, et cetera. And one thing that makes sense to me, even just how our supply chains work. I think COVID did shine a light on like, Jesus Christ, how fragile are our supply chains. I mean, this is nuts. And if you start having,
I don't even like to think about it.
Yeah, it's crazy. I think overall, what's interesting to me about Zoltan's thing, and this is again just the intro. He's got some really interesting, analysis on the price of money. So this Perry Merling framework. But overall, what he's describing there, persistently higher inflation, higher rates, demand for commodities, less demand for FX reserves. I mean, what you're describing is a complete unwinding of the monetary system as it's existed thus far. And one that's more based on commodities. The last story that I want to get your take on here, because I think it's so freaking interesting, is what's actually going on in crypto with Luna and Terra, right? So For those of you, I mean, Jason's podcast has done a bunch of episodes on this, but they just had Do Kwon on, actually, who's the founder of Terra Luna, and the UST stablecoin. But I mean, so for those of you who might not be aware of Terra Luna, that it's built on SDK. It's basically, it's an ecosystem that exists to create a decentralized algorithmic stablecoin called UST. There are also UST is the main product, but there are other stables as well. It's been collateralized primarily by Luna, but also what they're starting to do now is collateralize it with other assets, primarily Bitcoin. And there's something called the LFG, the Luna Foundation Guard, and they've essentially committed to a $10 billion Bitcoin buy. They've already bought, I think, 1.3 billion as of this time. And it's great. I mean, I don't understand why this isn't getting more attention, or this isn't more of a mainstream story. This is like the biggest Bitcoin buying spree ever. And I also think it's just interesting because it's a really bold experiment in something that looks like a native currency for the internet, a decentralized algorithmic stablecoin, and it's collateralized with Bitcoin, which is the internet's version of pristine collateral gold. And it actually looks something like the Bretton Woods system.
Can everyone please rewind 30 seconds and listen to the most elegant description of what is happening and why collateral matters that Michael just said? Please rewind 30 seconds and listen to his description of how and why. No, I'm deadly serious. That explanation was the clearest, most concise, and it's all about the collateral. Mm-hmm. It's always all about the collateral.
Yeah.
And this idea that the dollar has been and still is ish the pristine collateral. Treasuries were pristine collateral. Now, Bitcoin may become the pristine collateral. And right, we all know the saying, he who has the gold makes the rules. Maybe in the future, he who has the Bitcoin makes the rules.
Yeah.
And so please go back and listen to what Michael just said, because that, if you understand that one concept, you have a huge head start over 99% of the people out there.
I think the implications here as well, one trend that I've just noticed in crypto in the time that I've been here, right? There's this idea, the wall of money is coming, the institutions are coming, the big opportunity if you're building a company in crypto or if you're buying an asset because you're trying to front run the institutions, whatever, just front run this wall of money, just wait, it's going to come in. And 4 years later, I actually think the opportunity is in doing crypto native things, like fade the institutions, fade the banks, and actually pay attention to the people who are doing the most native, interesting stuff. And I wonder, like, for instance,
Two thumbs way up.
Like, let me give you an example. Like, okay, the internet was in the early 2000s, right? Did Walmart like successfully co-opt the internet and develop some great internet strategy, or was there a native internet online retailer, Amazon,
Microsoft,
that just ate everyone's lunch?
The Microsoft intranet.
Right.
The Microsoft intranet that Bill Gates was on David Letterman's show saying, no, you don't want this internet thing. You want our intranet.
Yeah.
Our person. No. You wanted the decentralized, not perfectly decentralized, but you wanted the broader internet. And again, rewind 30 seconds. Listen to Michael. This is the Listen to Michael's episode. This is awesome.
I'll conclude my point by saying I actually find it, as crazy as this prediction might sound, I find it more likely that instead of central banks buying Bitcoin, I find it more likely that crypto will create its own version of something that looks like central banks, and the world will find a way to integrate them. I think that is more likely at this point than central banks buying. I think central banks will probably buy gold. But I think,
central banks will buy Bitcoin. They will. Because they'll be forced to because of what you described. That this pull by the crypto native businesses moves us into the digital age. The legacy system, which will still exist. Everyone's like, oh, if you hate the dollar so much, why don't you just move?
I agree. I think it'll still exist. Yeah.
I'm going to live here for now. Although, government policies are making it harder and harder, but for now. And because I live here, I got to spend in fiat. And so, yes, I have a portion of my wealth in Bitcoin. and in other digital assets. Absolutely. That is my schmuck insurance. But I have to convert. Well, actually, I don't convert at all. I just use my fiat income to pay my fiat bills. I don't need to convert yet, thankfully, because inflation's not 1,000%, which they're working on. But look, I love the Do Kwon story. So I almost said at the beginning in my April Fool's joke that I was the guy selling to Do Kwon, but I didn't want to go there.
I just am attracted to people making big bold bets. I love them. I just think it's. I just think they're fascinating.
It's how the whole world. I mean, you're a student of history. Mm-hmm. It's how the world is created.
Yeah, you
can't cross a chasm in 2 small jumps.
Yeah, no, I just think
you can't.
Yeah,
it's impossible.
Yeah,
Evel Knievel showed us that. And people are like, who the hell's Evel Knievel? Look it up and look at the Snake River Canyon. He didn't quite make it.
Yeah. So we shall see. But anyway, Mark, this has been a ton of fun as always.
The thing I love about today, it felt like 2 or 3 hours.
Yeah, this was a good one.
It's such a good conversation, and just felt longer. But again, best hour of my week. I appreciate it so much, and have a great weekend.
Cheers, my friend. I'll talk to you soon.